Jonathan Garner joins us, Chief Asia and Emerging Market Strategist with Morgan Stanley. It's a pleasure to have him back on ET Now. Jonathan, so nice to have you back on ET Now. Our viewers always look forward to your thoughts and our engaging conversations. Jonathan,
thank you, Fed.
The Fed has moved on expected lines and they've acknowledged that we are at war and we will crush inflation. What does that mean for financial assets?
Well, it is quite a moment. I mean, a 75 basis point hike, the first time they've hiked by that amount in, I think, 28 years. However, we are already deep into a bear market, at least in my coverage in overall emerging markets. It's really, you go all the way back to early 2021 when our markets peaked. That's the overall EM index. So we're an awfully lot cheaper than we were back then. Earnings estimates revisions have been negative for some considerable time. So we think we're actually quite late on in the bear market, unlike the S&P, which has only really got into a bear market this year. But what's not clear to us is how we plot a path to a new bull market. We think it's much too early to be thinking about a new bull market.
Interesting. I'll come to that, Jonathan, in just a bit as to which stage of the bear cycle and the bull market we're at. But first, I want to talk about, the terminal rate for the calendar year by the Fed overnight, which has now been spiked to 3.4%. That indicates an additional 150 bips rate hike earlier than anticipated over the next 4 meetings. Is that going to shake off markets? And is that going to continue to hold us abated and for the bear market to continue?
Well, they're certainly front loading the rate hikes now. That's very clear. And they're doing it at a time when many macro indicators, particularly on the consumer side and let's say the traded goods side are softening. So we do think at Morgan Stanley that there's still downside risk. So for the S&P, my colleague Mike Wilson is targeting 3,400 to 3,500 before we really get valuation support. At that level, you'd be trading about 15 times forward PE. Now, again, just to be clear, we actually do modestly prefer overall emerging markets in Asia to the S&P 500. So we don't necessarily need to fall as much this year as the S&P, given that our bear market began last year. But if we're right that the S&P is falling, it's difficult to think that our markets are actually going to go up.
So, Jonathan, are we in for then a protracted period of what is called as time-wise correction stroke consolidation, where we may not fall, but we may not rise?
Well, I think I should speak a little bit about the India market, which is slightly different from overall emerging markets in the sense that last year it held up much better, India, than did China. In fact, all of last year we were overweight India and cautious China. That changed a little bit towards the end of last year when we felt valuations had become excessive for India. We're tracking at the moment negative earnings revisions for India. Whereas, for example, the commodity exporters part of our coverage, like Indonesia or Australia or Saudi Arabia, are actually experiencing positive revisions. So I think for the India market itself, our overall view is it probably tracks lower, tracking those downward estimate revisions. And we have to watch how the RBI responds to the Fed. The RBI has quite rightly begun a rate cycle. There are some modest inflationary pressures in India itself. So I think the India market is probably going to be more correlated with the S&P 500 than some of those other markets I just mentioned that have positive earnings drivers around being commodity exporters.
Jonathan, the striking feature for us has been this flood of FIIS selling, and numbers are large and slightly disturbing. What is your sense? Do you think the selling from foreign investors is here to stay when it comes to India?
Well, as I mentioned, it's not one of our top pick markets. We are seeing other markets where foreigners are reducing positions, particularly in Taiwan and Korea. Obviously in China, they were steady sellers all of last year and the early part of this year. But I would expect that the India market will be characterized by continued outflows from FIIs for a little while longer. until we really get a peak in the US dollar. That's a tremendously important topic to discuss here. If the US dollar peaks, which is round about the time likely when inflation peaks and the Fed front loading is fully priced in, then I think the environment can get a little bit brighter for India. But at the moment, the trade-weighted dollar just globally remains very strong.
Interesting that you say that, Jonathan. For India's base case to improve and for you to turn bullish on India, would it only be the dollar, or are you going to maneuver, or rather, closely watch out for crude as well? Because while every and any asset class has come down, crude hasn't, and that really impacts India.
Yes, that's right. And it's also a positive for some of those markets I mentioned, like the Middle East markets or Brazil or indeed Indonesia. It's also heavily represented in the index in Australia, oil and gas. So yes, essentially it's this dynamic between what the Fed's doing, what the dollar is doing, and what commodity prices are doing. So as a sort of a cocktail, they are negative for India right now relative to some of the rest of our coverage. But we're also tracking a bottom up, this declining earnings estimates revisions. So, whilst it's not an outright underweight for us, India is definitely a market that we're relatively cautious on.
Overweight on India, or for India to become your most preferred market, would you be waiting for macros to turn, or would you be waiting for absolute price correction to kick in?
Well, I think it's that macro environment would have to be improving. Plus, we do need to see lower valuations. If you look at the relationship between forward PE or price to book and return on equity in India, it is actually one of the more expensive markets in our coverage universe and indeed globally. So precisely because it was relatively resilient in performance last year, it's not particularly cheap on a relative basis now. So we need to watch that relative valuation as well.
Good morning. One question. At the start of this year, you were saying that your year-end target for the Sensex would be 70,000, with the union budget being a catalyst. We're now in the middle of the year. We didn't know about the war back in January. We didn't know a lot of things back in January. But now that we're in the middle of the year, for the Indian markets, while you're cautious, what are you saying? Neutral returns, negative returns?
Yeah, so that target set by my colleague Ridham Desai, and you're right, it was set towards the start of the year. I think it's fair to say that we've all got incrementally more cautious since then. It's not unachievable. We actually think that after the S&P, for instance, goes down to 3,500 near term, it will probably rally from there, assuming that we escape a global recession. I mean, that's the key thing that might keep the S&P at depressed levels, and the Indian market too, obviously, if we get a global recession, because that would lock in very low valuations. So again, the comfort level around that has been reducing somewhat recently. And that's where the debate is. That's why global markets have been under such pressure. So that's how I would sort of frame it. Yes, a target like that is still achievable over the medium term, but we need to avoid a global recession.
Oh yes, that ugly R word, and especially since yesterday the conversation has been that are we now going to see a US Fed-induced recession? But Jonathan Garner, with what all has been announced by the US Fed and the Chairman Jay Powell yesterday, there are many who believe that the US dollar may have peaked. That should be good news for the EMs, and then shouldn't it also be good news for India?
Well, yes, but there's no proof that that's actually anything like a sustained trend. It's certainly noteworthy, you're right to note it, but we'd want to see the establishment of a generalized dollar weakening trend before that would ease financial conditions in emerging markets. And for example, the RBI would have less need to be increasing interest rates, all of that sort of environment. So it is noteworthy that was maybe the one-day reaction or afternoon reaction to the hike.
Jonathan, so we are debating right now whether it's going to be a soft landing or a hard landing. So if there is a recession, then how much collateral damage do you think it could potentially happen to financial assets?
Well, if you look at the emerging markets overall that I covered, as I said, we're 450 days plus into a bear market. We're down around 30% from the peak. The China market at its worst was down 60% from the peak. So we've come a long way already. I think that if you look at our bear case target for emerging markets in a global recession, it would have maybe 10 to 15% further downside. So we have come a long way. Valuations are now starting to be outright cheap for EM overall. That's less true for India, but for EM overall. As I said right at the beginning of this interview, we think we're late on in a bear market, but the way that the bear market ends in our world, in the emerging markets, is not clear. It's not clear that oil is going to fall, that the dollar will weaken, that the financial conditions tightening is going to ease, and it's not clear where the earnings environment is. So it's better to remain relatively cautious and just keep doing the simple things that are working. And in my coverage, what's working is the markets and sectors that have upwards earnings revisions, and they are almost invariably the commodity exporters. So the Middle East, Latin America, Australia, Indonesia, and indeed Singapore, which is a market that trades a lot with ASEAN and has some energy representation in the index. These are all the markets that we tend to prefer.
Jonathan, where are you on this value versus growth debate? Because if interest rates are moving higher, asset repricing will also happen. Is the global style changing now that you mentioned that you're bullish on energy, commodity producers rather than consumers?
Yes, so hopefully we were very clear on that across all the markets and regions we cover in our year ahead piece last November. We were overweight energy in every region and overweight value stocks in every region. And that remains the case. The only thing I would say is that the underperformance of growth, particularly long duration, low quality growth, has been quite spectacular this year. It's linked obviously to the underperformance of NASDAQ, for instance, versus the overall US equity market. So yes, we do favor value relative to growth as a house view still.
Jonathan, India has always commanded a premium because of better corporate governance, ease of doing business, and factors and better return ratios which Indian companies always have delivered. Where does that fit in this kind of a world where everything is getting reset?
Yeah, so the valuation premium for India, we can be relatively precise on that. It's around about a 40% premium to overall emerging markets. And that's slightly higher than the average. The average is around 25%. So it is somewhat concerning in the context of negative earnings revisions. So we'd rather see it flat on that historical average before we got more constructive on India.
Really appreciate your time. So glad you could join us, and thank you for joining us on this very big morning.
Thank you for having me. Thank you.